Let's compare putting down a 5% deposit v 20% deposit on this beautiful villa on the outskirts of Melbourne. And we're going to say you bought this place for 400k, which is just shy of 10% under market value. And the current rent for a place like this is $400 a week or just over $20,000 a year. So for a 5% deposit, that's just over 20k. It's another 20 odd k for stamp duty, 3k for legal fees, and just over 11 grand in LMI, which means you'd need just under 55 grand to cover the upfront costs. The big issue with going in with a lower deposit is you are seen as a higher risk by the banks. They make up for this high risk by charging you higher rates. So that means in this case, for a 95% lend, the loan amount would be $418,000. The interest rate would be just over 8%, which means your total repayments for the month would be $2,700 or just under $33,000 a year, which means you're going to be heavily negatively geared. Now, for a 20% deposit, that's 80 grand. You wouldn't pay $1 in LMI, stamp duty and legal fees wouldn't change either, which means your total funds to complete is just over 100 grand, which is almost double the savings needed compared to a 5% deposit. Now, from a lending standpoint, you're seen as a lot less risky. We're going to say that you chose the repayments of interest only for 5 years at a rate of 6.29%. That's just over $1,600 a month or just over $20,000 a year. This place would still be negatively geared, but at least the rent is covering the mortgage. Now, if I were buying this property, I would still buy it at a 5% deposit, even though the running costs are way more expensive. The 5% deposit option means I can get into a growing market sooner with less of my own money. And because I did myself the solid of buying this under market value, after 6 to 12 months of owning it, I can get it revalued and refinanced to a better bank with a sharper rate, helping me with my cash flow.